China's Finance Ministry on May 14th announced that it will start implementing a consumption tax on mixed aromatics, light cycle oil, and bitumen blend from June 12th, as it looks to close a loophole in its tax system. Mixed aromatics and light cycle oil, or LCO, are used as blend stocks in gasoline and gas oil, and bitumen blend is used as a feedstock by independent refiners. The implementation of this tax is not only expected to have repercussions in the domestic market, but also in the regional refined products market and crude market. Welcome to this episode of Global Oil Markets Podcast, the Asia edition. I am Raganka Jepuriar, Head of News in Asia at S&P Global Platts. To learn more about China's new consumption tax, I have with me today Grace Lee, Senior Analyst, Oil Analytics Asia, Oceana Zhou, Senior Writer on China with the Platts News team, and Suyin Cheong, Managing Editor, Clean Product Markets. Oceana, tell us a little bit more about these products. What are they used for, and who are the major suppliers to China?
Sure, Miganka. Light cycle oil actually is catalytic diesel, which can be blended with kerosene to produce gas oil. The blended barrels of gas oil are popular in construction, mining, fishing, and agriculture sectors. South Korea supplied more than 60% of the LCO barrels that China imports. Mixed aromatics, on the other hand, are components to produce gasoline. Most of the mixed aromatics are diverted from Singapore, the Asian trading hub. Bitumen blend is heavy crudes like Venezuela Marie crude and Iranian crudes are the major grades. But the barrels were declared as other country origin, especially Malaysia. Independent refiners are the end users using them as feedstocks to produce asphalt. Bitumen blend imports also rise when independent refineries are short of crude import quota, because there's no quota limit when the crudes are declared as bitumen blend.
So several products in China have carried a consumption tax for a long time. What is the government thinking? Why implement this tax now on these specific products?
The government actually stated in its announcement that introducing the tax on these products is to seek to make a fairer tax system and dampen use of the environmental unfriendly fuels. All these import products are subjected to consumption tax from June 12th. But before that, the gas oil and gasoline barrels that blend from LCO and mixed aromatics were easy to evade consumption tax. In comparison, gas oil produced from domestic refineries attracted about $28 per barrel consumption tax, while gasoline attracted about $39 per barrel. China has restricted sulfur content for gas oil to below 10 ppm. But the barrels blended from LCO are with more than 1,000 ppm sulfur content. In addition, the government intends to use quota to restrict the crude imports by the independent refineries to close the loophole that bitumen blend imports. The imports of these products surged since April last year, which attracted the government's attention. With the new tax, imports of these products will fall significantly until market players will find a way to get around.
So if I may add, contrary to popular belief, I think initially people were only expecting LCO to be implicated by the tax. So by including mixed aromatics and blended bitumen, I think the government is essentially saying that it will no longer tolerate any forms of illegal blending. So it's also notable that the new taxes actually came on the back of a series of other measures implemented over the past several months to weed out errant behavior, which is quite rampant in the independent refineries. So we also wanted to point out that these taxes were implemented even though it could potentially lead to a rise in fuel prices in the domestic market and stoking inflation. So given this, it really reflects how much the government wishes to stamp out some of these illegal blending activity.
Grace, your point on inflation is a very interesting one because we're seeing that play out in several commodities in China, much of it driven by their own domestic policies. Factory gate inflation has risen by over 6%, and the government is clearly concerned. What impact do you see this tax as having on inflation?
So Platts Analytics, in our calculations, we believe that the increase in wholesale prices could possibly be as much as about $10 per barrel as the marginal supply becomes more expensive. And of course, this is for both fuels. So the rise in fuel prices could impact the input costs for the agriculture and industrial sector, as highlighted by Oceana earlier. These are the biggest users for these fuels. This could stoke inflation, and it's also very politically sensitive because most of these buyers are actually in quite price-sensitive sectors. So the State Council has recently stated that it will step up efforts to curb fast rising commodity prices, as highlighted earlier. So given that, it really reflects how much the government wishes to stamp out some of this illegal blending activity. Either that or actually the wider implications for these taxes haven't really been considered.
That's interesting. Thanks, Grace. Because also this tax is not only going to have implications in the domestic market, it is going to have far-reaching implications for the regional refined product markets and also the international crude markets. So let's go over these one by one. Firstly, which products get most impacted?
No question, LCO will have the biggest impact because its volume increased significantly in recent months and already costs over 2 million metric tons per month, which has also sent pressure to Chinese refiners to lower their gas oil yield significantly in the past few months. That means China had to rebalance its gas oil import production and exports. Mixed aromatics though will have the least impact because the import volume is limited, always below 1 million metric tons per month. But bitumen brand will have some impact on independent refineries' crude demand because that crude imports may have to limited by quota. But I think like state-owned refineries will make up the reduction.
And Grace, what is the Platts Analytics view on how this tax will impact product balances in China?
So as we highlighted earlier, Platts Analytics believe that there will be higher prices in the wholesale market. And if that's the case, I think we think the biggest impact will be on exports because this would basically make it uneconomical for refiners to send product overseas. So after all, if we look at the numbers, domestic wholesale prices were mostly higher than the netback ones from the pricing hub in Singapore. We saw a similar situation in the second quarter last year when the price gap between the two markets was so large that China's exports pretty much more than halved at one point. So we just wanted to explain our point on exports. In my mind, I think taxes could cause imports of blending materials to fall significantly, as also highlighted by Oceana. And as gasoline and gas oil supplies from private refiners and blenders drop, the NOCs and possibly also some larger independent refineries that have quotas to send product overseas may be in the best position to fill this gap. So to do so, they generally have two options. To do nothing to runs and reduce export to the extent of volume lost by independent refineries, or two, import additional crude and process them, keeping exports intact. So we believe in the end, this will be driven by a range of moving parts, and a likely scenario will be doing something in between, probably less product exports, considering where regional cracks are and expected to be. Refiners will likely also need to import more crude and run them due to some demand-supply mismatches between regions that will prevent some refineries from reducing their exports.
Thanks, Grace. I think your point on potentially lower gas oil exports is a very important one. And Suin, I want to pick your brains on what the implications are for the regional gas oil market and what does this generally mean for medium and high sulfur gas oil?
Certainly, Muganga. Let's take a look at a couple of weeks back. Prior to the announcement, the Asian gas oil market was largely range-bound. Demand concerns due to the new COVID-19 waves around the region, especially in Southeast Asia, were basically offset by tight supply balances due to ongoing turnaround season and production cutbacks. Platts FOBS Singapore cash differential for 10 ppm sulfur gas oil was also largely range-bound, reflecting the patchy requirements from key demand centers. Now, following the announcement on the tax consumption on LCO, the market took a breather for about a couple of days to digest this news. That was when industry sources realized that Chinese majors will start to reduce exports to focus on fulfilling domestic requirements. I think this is what Grace has actually discussed as well earlier on. Right? Several traders estimated that with this reduction, it will actually translate to a monthly loss of about 500,000 tons of gas oil. Some say that this could potentially be more. Right? And if we look at the latest Chinese customs data, this will actually translate to about 30% of China's May exports of around 1.9 million tons. The expectation of supply loss from China pushed the 10 ppm sulfur gas oil premiums to its highest level this year at plus 21 cents to MOPS gas oil assessment on May 14. This was also the highest premium since July 2020. With the shortage of ultra low sulfur diesel, because China basically exports the majority of it is actually low sulfur, and LCO with the higher sulfur in content would basically mean that South Korean barrels will likely be sold as medium and high sulfur gas oil. We saw the price spread between the 10 and 500 ppm sulfur gas oil widen to more than $2 per barrel since last week. And this is also the widest since middle of May last year.
Given how the significant role that China plays as a regional supplier of products, what implications is this going to have on trade flows? How do you see trade flows shifting?
Right, there's definitely going to be implications on trade flows. Let's look at the biggest shot in the region, which is actually Australia. Now, China has been a key gas oil supplier for Australia. Compared to the other countries in the region, Australia has been praised by many for successfully containing the outbreak and keeping the number of infections low. Right, these factors have actually certainly helped in the country's economic recovery, and combined with refinery closures, we have ExxonMobil's Altona, BP's Kwinana as well, which have actually announced closures, right? All these factors combined have all contributed to a strong appetite for oil product imports, especially gas oil. If we look at Australia's customs data in March, right, diesel imports hit a 9-month high, right, with China topping the suppliers list. And in the same month, contributions from China alone jumped by more than 150% year on year. This will mean that Australia will have to find alternative source of gas oil supplies from the region. For example, Singapore, Malaysia, India, or could be Middle East as well.
And we've mentioned South Korea as a major supplier of LCO to China, light cycle oil to China. Given that China's imports of LCO are obviously expected to drop now, what does this mean for South Korean refiners?
Right. We understand that South Korean refiners have completed June sales program for LCO. Many of these cargoes changed hands at about $2.50 to about $3 per barrel on an FOB basis. We are now hearing that some of these trades, unable to meet the 12th June deadline, will be cancelled. Right? All these unsold LCO, right, and displaced LCO barrels will then be sold in the spot market as medium and high sulfur gas oil. Recently, GS Caltex actually issued a sell tender for 7 gas oil cargoes, all these 7 cargoes are 500 ppm. These cargoes will be for loading from Yosu, and industry sources have said that this is actually not normal, from the usual 1 to 2 cargoes per month. Also, some industry sources have said that it will take at least 6 weeks for a refinery to change slate, and this will mean that the South Korean refiners are now caught long on LCO.
So we have Australia, which is short on gas oil, and South Korea, which is long on LCO. But obviously, there is a mismatch in specs. So they're not going to be able to kind of fit and meet each other's needs.
Yes, unfortunately not yet.
And consumption tax is also expected to have an impact on crude markets, creating some additional demand from China for crude. Clearly, a development that crude suppliers are going to be excited about and will be watching closely. Grace, what is the Platts Analytics view on crude balances in China?
So Platts Analytics, as we highlighted earlier, we expect that the whole impact on this consumption tax is a mix of a fall in exports and a rise in runs by the NOCs to make up for that shortfall. So in terms of crude, there will be additional imports, but this will be principally by the NOCs, as they will have to make up for some shortfall in supplies by processing more crude. Further imports from the independent refineries as a result of taxes on blended bitumen, though, will be constrained by quotas for these players, unless for some reason or the other quotas become higher, which is still possible. So if we look at numbers from 2020, independent refineries have fully utilized their crude import quotas for the year. And so the upside for this year, 2021, is actually quite limited. So we also wanted to point out that at the end of the day, China is unlikely to want to become a big importer of crude just to export products. I think that the priority for the country is more on self-sufficiency. And there's also a growing focus on returns on investments for some of these export refineries, especially NOCs, and poor export margins will actually curb product exports and ultimately imports of crude.
It will have to be a balance, right, of lower exports and higher runs to meet the domestic demand-supply mismatch. Oceana, what grades will come into favor and which ones will fall out of favor? How do you see independent refiners' buying patterns getting altered?
Yes. Due to the new tax, market participants expect the good grades with higher gas oil yield will be favored by Chinese refineries to meet the demand to produce gas oil domestically. At the same time, heavy crudes like Iraqi, Basra heavy, Canadian Cold Lake will be popular to replace bitumen blend as feedstock to produce asphalt. But for the independent refineries, so far we see they are actually quite quiet in the crude market due to their tight import quota availability.
Thanks, Oceana. Grace, my final question is to you. I understand Platts Analytics has looked at various scenarios. Could you talk a little bit about that? And also, what are some of the challenges that this is going to cause in the domestic market?
So Platts Analytics believes that to make up for all that lost blending materials, we need to fill a supply gap close to around 1 million barrels per day of crude. Some of this, as highlighted earlier, we made up for by exports, but will not be done completely. If we look at the numbers, even though margins for exporting products were poor in 2020, we still saw around 600 kbd of exports for the three main products, jet, gasoline, and gas oil. And this is roughly equivalent to about 500 barrels per day of crude. So the rest will have to come from higher runs. So if the NOCs were to fill this gap, I mean, just looking at the numbers, they would need to run close to their historical peaks or optimal for every month. And this leaves virtually little room for downtime, which will be quite a pressure on supply in the market. So higher runs from new refineries, we argue, could contribute to some of this supply, but these refineries actually produce quite little products because they are mostly geared towards producing petchems, and their yields for gas oil is actually very low. So based on the current use that we are seeing, filling the gap for gas oil will actually be an issue. As Oceana also highlighted, LCO actually makes up a larger part of the gas oil supply compared to mixed aromatics, especially as what we have seen in 2020. So again, also another challenge potentially is that the NOCs, they have been reducing their gas oil to gasoline output ratio over the years. And to fill that additional gas oil supply, they may potentially need to reverse some of these yields. And given all the investments that they have made in the past to boost their gasoline output, some of these returns on investments will be put into question. And especially given a scenario where they are actually increasing focus on returns. The last 2 points we'd like to make is that higher prices could also have some ramifications on demand, which we have not factored into our estimates, but could potentially be the case. At the end of the day, how much a lot of these different scenarios will pan out actually depends on how successful this new tax policy is on curbing inflows of these materials. One of the caveats in the new policy is LCO and mixed aromatics used in petchems will continue to get rebates. So like in the past, we think there's still room for refiners and blenders to find loopholes to escape paying consumption tax. I think eventually, at some point, another HS code possibly could provide room for additional inflows of some of these blending materials like we have seen in the past.
Thank you, Oceana, Grace, and Sueen for your insights. And a quick note to our listeners, the agenda for the upcoming Platts APEC is now available on our website. Do visit spglobal.com/Platts for the details. And thank you for listening.